price of Brent oil. That's the global benchmark. Europe uses it tremendously. London, as you can see in that trade, oil there, $107.15 a barrel. Traders are betting that Libya will be able to ramp up its oil production to where it was before the uprising began back in February. We're going to speak now to a top deal maker in the energy business, Tom Petrie. He's vice chairman of Bank of America Merrill Lynch. He joins us on the phone from Denver. Tom, welcome back to InBusiness.
Thank you, Margaret.
What is the exit, or at least the end of power for the Qaddafi regime, going to mean for global oil supply?
Well, it should loosen things up somewhat. There was no question when all this began back in the first quarter, there was a tightening up of the light oil supply, and the ability of the Saudis to crank up their alternative sources of crude oil was only a partial offset. And that's part of why we ended up seeing the release of strategic reserves. At this point, I think the ability of the Libyans to bring it back is probably going to be pretty good. I think the incentive for the former companies that were running those fields to come back and be helpful is going to be there. And so overall, I think it's a relief to the system and a relief to the tightness that was induced earlier this year in global supply.
Now, we have heard from the rebel government that they're going to honor pre-existing oil contracts with the Qaddafi regime and allow those foreign producers to come back in. But Morgan Stanley raised its outlook for oil just a few months ago, saying it's not as easy as turning on and off a switch. Even if you idle a well, there is damage. It's not so easy to get 1.5 billion barrels back on the market.
Yeah, that's a good point, and I'm not saying it'll happen overnight by any means. It becomes very reservoir specific. Field by field, the situation can be somewhat different. Generally, in these kinds of fields, I don't think the risk of damage is particularly large. Usually what you're talking about is either water encroachment or other fluid impairment that occurs when the wells are shut in. And this has been relatively brief for that kind of damage to be a big concern. So I'll be surprised if that ends up being a big problem.
Does this present any new opportunities for deals to be made here?
It's hard to say. I think in the near term, it's mostly the macro effects. There was a dislocation in the global system where that light oil had to go to, when you cut that off, then you had to divert light oil from other markets in order to meet Europe's needs. We'll get back to a business as usual mode, I suspect, during the course of the balance of this year. In terms of deals per se, if anything, it is contributing to maybe a lower average crude oil, weighted average crude oil price later this year. And frankly, we've come off enough already that incentive was already in place.
Yeah. Well, Tom, always good talking to you. Thanks very much for calling in there from Denver. Vice Chairman, Bank of America Merrill Lynch, top oil deal maker with important insight.